Just now we have finished the concept pertaining to double entry system, in which we have understood that total assets is equal to equity plus liabilities, and we have gone through the income statement and balance sheet of Coca-Cola, in which we have seen income, expenses, assets, liabilities, and equities of Coca-Cola. These are classified into various types of accounts. They are nothing but personal account, real account, nominal account. Let's understand what is the category of transaction which goes into personal account, which goes into real account, which goes into nominal account. Let's start with the personal account. Personal account includes natural persons like you and me. It includes individuals like Warren Buffett and Bill Gates also. Then let's look at artificial persons. Artificial persons are created by law or statute. These are nothing but corporations like Microsoft, Google, and Amazon. For personal accounts, the accounting principle is debit the receiver, credit the payer. Then we have something called as real accounts. Real accounts are carry forward accounts. That means these account balances are carried forward year after year, like buildings, cash balances, wages payable, equity account. Here the principle is for recording the transaction is debit what comes in, credit what goes out. Then the other type of account is nominal account. This represents mainly income and expenses, which includes transactions like sale of goods, purchase of goods, wages, taxes. So here the principle is debit expenses, credit income. Now that we have understood all the three accounts and what is accounting principle for recording these particular accounts, let's try to look at a practical transaction. In this transaction, we have purchased a building from Mr. Gates in cash for USD $1 million. In this case, what is happening? Building is a real account, debit what comes in. So building is coming in, so we have to debit the building, and we are paying the cash. Cash is also a real account. So in case of cash is going out, so credit will be cash, the entry will be building account debit, cash account credit, to cash account credit being building purchased for cash. Now let's change the transaction slightly. Instead of paying the transaction in cash, let's assume the transaction has happened in credit. In this case, we say to Mr. Gates, sorry Gates, we don't have money, we'll pay you after 1 month. And Mr. Gates also says, okay, fine, please carry on with the transaction. So in this case, we are getting the building, control over the building. So building account debit, and here Mr. Gates is a personal account. In case of personal account, debit the receiver, credit the giver. Here Mr. Gates is giving us the building, so we have to credit him. Two Gates being building purchased from Mr. Gates in credit. So this is the way we record this transaction. Now let's look at another transaction. Here we have to pay rent to Mr. Jackma. We have paid that in cash in the first instance. So here rent is an expense. Expense is a nominal account. Debit expense, credit income. So this is a principle with respect to income and expenses. So here rent account debit and cash is going out. So cash account will be created. Rent to cash being rent paid will be the narration for the transaction. Let's assume instead of paying in cash, we tell Jackma, sorry Jackma, we don't have money. We'll be paying you in another 1 month. If he says it's fine, then we have to record the rent expense. Rent expense is anyway recordable. But however, Jackma is a giver because we are telling him we'll pay him after 1 month. So we have to debit rent expense to Mr. Jackma, credit $1,000 being rent payable to Jackma. This is the narration for this transaction. Now that we have understood the concept of debits and credits, I'll tell you a shortcut. Instead of going through all the personal account, real account, nominal account, principles, and all stuff, you can remember this following table. If you remember this following table, you will know when to debit which type of transaction, when to credit which type of account, kind of thing. So in case of assets, if it is increasing, you have to debit it. In case asset is decreasing, you have to credit it. So if you see earlier transaction, where we have bought building for cash, so where building balance is increasing, so we are debiting it. Cash balance is decreasing, so we are crediting it. Similarly, in case of liability, if it is increasing, we have to credit it. In case of it is decreasing, we have to debit it. In the previous transaction, we have seen like where we are telling to Mr. Gates that we will pay the amount pertaining to building. after 1 month. In that case, we are getting a liability and the liability balance is increasing. So we are crediting his account. So this is alternate way to remember the principles. Then similarly, in case of income statement, let's say expenses. If expenses are increasing, we have to debit it. If expenses are decreasing, we have to credit it. In the previous transaction, where rent is paid or payable to Jagma, rent expense is increasing for the period, so we are debiting the transaction of rent. Similar way, if income is increasing, we will credit it. If income is decreasing, we will debit it. So this is a shortcut to remember which account to be debited or which account to be credited. Hope you understood this shortcut and it will be handy while recording the transactions. I hope you are enjoying our course. Please leave us a 5-star review in the course review section. Thank you.